Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-host for Upticks.
Today is our 33rd episode, Mythbusters.
We're going to talk about advisor myths, questions worth asking, and provide you our January market update.
Okay, Corey, for our audience today, we wanted to talk about some common financial advisor myths that are out there. I think a lot of people in the general public get a little confused because a lot of people are out there portraying themselves as professionals when in fact they're ultimately just salesmen.
Right.
So myth number one that we wanted to talk about, and I've got it written down here, is are all advisors acting in your best interest?
False.
Okay.
The idea with financial advisors, and that's a very broad term that we're using here, is generally speaking, an advisor is going to be either a broker or a fiduciary or an advisor, in other words. However, there's also some people that attempt to be both.
How could somebody both be? Well, first let's rewind it a little bit. Yeah. Why don't you tell everyone what a broker is?
Sure. So a broker is, think of a salesperson. It's the simplest way to think about it. Somebody who is compensated for a transaction. If I'm a broker and I buy you shares of XYZ stock or ABC bond, typically you're going to pay me on the transaction. That's how I'm going to earn my compensation, and then we both sort of go our separate ways.
So maybe examples of brokers would be like my real estate agent?
Yes.
Or maybe my car salesman?
Exactly.
Right, not necessarily bad people. They just are paid on a transaction by transaction basis. They're probably going to give you advice as to what's suitable for you, but it doesn't necessarily have to be in your best interest. Another way to think of it is maybe the grocery store, right? They might have Little Debbie's on sale.
Sure.
Right, and then so in that capacity, they're acting maybe as a broker. Hey, we think you should buy these; they're cheap.
Right.
In that sense. Okay, so then you mentioned another type. What is that? A fiduciary?
Yeah. So a fiduciary is, I'm going to use a fiduciary. Think of a fiduciary as an advisor, meaning that is somebody who's legally obligated to act in your best interest.
Okay. So maybe some examples of a fiduciary might be somebody like an attorney?
Exactly, or I think of like a doctor that takes the Hippocratic Oath. It's not about what's suitable for you, it's about what's the best thing for you. Just like an attorney has a fiduciary obligation to its client. It has to do what's right for its client.
Maybe also a dietitian, right? Somebody that says, hey, you shouldn't buy all those Little Debbies.
Exactly.
Right, because it might not be good for you.
Right, and they say, hey, go for some vegetables or some fish or something like that, right?
So then how can somebody, so then you mentioned here that somebody could be both. How is that possible?
So this is my opinion, but this is the most convoluted, complex, and probably the worst approach that somebody could take in trying to be both. Because the challenge there is, if I'm a client of yours and you're trying to be a broker and an advisor, unless you're telling me with full transparency, which you're not required to,
right.
Every single recommendation you make, whether you're getting compensated on that transaction or whether you're saying, actually, Corey, so this is a transaction, but this is what's in your best interest. In my opinion, it's not possible.
Why do you think firms then would allow their advisors to do that?
I think the obvious reason is because the laws and the regulations allow it, unfortunately. But from like a bank standpoint or a firm standpoint, it's a different way for a bank to diversify revenue that's getting generated. In my opinion, meaning.
So can my dietitian though tell me to eat more fruits and vegetables and buy Little Debbie's? Why would I work with that person?
I don't know.
Right, they might say Little Debbie's are on sale, you save some money, go buy Little Debbie's, but we also want you eating fruits and vegetables. That's what's confusing to me also. So I think it's just the myth that we're busting is that, first and foremost, in our opinion, it's impossible to be both.
Correct.
Right, I think that's what you basically summed up. It's impossible to be both.
But so many people have tried it. And so many people still try that. And the issue there is the client doesn't know whether or not.
Right.
The client thinks that their broker is a dietitian, right?
Yeah.
That's the problem.
Right, so that's myth busted number one is not all advisors act in your best interest. And an easy way to ask, and it's not an offensive question, is just to simply say, if you're interviewing an advisor to work with them, hey, are you a fiduciary all of the time with all of my investments?
Exactly.
Okay, good. What's myth number two that we're going to talk about?
All right, myth number two, I have it written down here. All advisors have the same service model.
False. They
All
don't.
right.
And I've actually started to notice this here lately. I've got more and more potential clients calling me saying that they never hear from their advisor, which I think is ridiculous for an advisor to charge somebody an annual fee and never call their clients or meet with them. We're very specific about our client service model at Falcon Wealth Advisors. We also don't scale it. A lot of people in the industry, they'll only maybe meet with their largest clients, and then their smaller clients, they'll wait for them to call in. As far as the way we do it, we think meeting with the clients twice a year makes sense. We like to call them twice a year on top of that. And also our assistant Samantha will typically check in with them as well. So our service is pretty clearly defined. But just because you're working with an advisor, even if you're working with an advisor at a very large firm, that doesn't mean that every advisor within that firm may look at their service the same. So another very easy question to ask somebody is, hey, what is your service model? How many clients do you have, and how often will I hear from you?
And if I was shopping for an advisor, or if I was working with someone and I didn't know the answer to that, I would expect to see something like that laid out.
Yeah, in writing.
Not somebody just coming up with something on the fly.
Good point.
Because typically advisors, the more clients they have, in theory, the more money that they can earn. So advisors will focus on onboarding new clients and not spend their focus on servicing their existing clients.
Right. So yeah, so you just want to make sure and recognize that, like maybe your dentist you see twice a year, and that's pretty standard in the industry. It's not that way with advisors. So advisors' service is all over the place.
Exactly.
All right, so let's go. Myth number 3 here is, I've got it written down here, are some advisors have a foolproof investment plan with guarantees?
False. Also.
Okay,
so there's a recurring theme here.
We're 3 for 3. So talk about this myth.
Sure. I think that there is a general perception that investors and clients of advisors are looking for some type of investment strategy that's going to make them a ton of money when the market goes up, but they're not going to lose any money when the market goes down.
Yeah, a perfect world, right?
Sure, of course. Yeah, sounds good to me too, right? The fact of the matter is, if you own stocks, right, whether we buy individual stocks, whether somebody buys a mutual fund for you, which we've talked about on previous shows, or an exchange-traded fund, or has any exposure to the stock market whatsoever, or you've gone and picked the investments within your 401k, and you pick those out yourself, the reality is if the stock market goes down, those investments that are invested in stocks are going to go down
Or may
also.
go down, right?
And it doesn't mean that there's any, or they may go around. It doesn't mean that there's anything wrong with that by any means. I know that there are some people that have come to me that have said, so-and-so has a strategy that makes money when the market does well and doesn't lose money when it goes down. And I said, well, if they can explain it to you, come explain it to me too, because I would love to implement something like that. It just doesn't exist.
Right, so the bottom line is there are no guarantees out there when you're investing in the stock market. And any advisor that's portraying themselves as having that's a huge red flag.
Yeah, it's a big no-no.
If you're in the market, like Corey said, and the market goes down, you should expect your account to go down. And when the market goes up, you should expect your account to go up. Again, the idea is that the market goes up more often than it goes down, and that's why people invest in it. But it is a big myth that some advisor has some secret formula that they figured out, and they're beating the market, and then they're guaranteeing returns. That's ridiculous.
Right, and there's two things there. One is, if somebody had that figured out, they wouldn't need to tell other people how to do it, nor would they even need clients to just do it with their own money.
That's a good point.
But secondly, there's some that value that can be added, right, from an asset management standpoint. That, for instance, that's why we use individual stocks as opposed to just going out and buying the indexes for our clients. But we recognize, and our clients recognize, that if the stock market goes down, a realistic expectation is that our stocks are going to go down as well, but hopefully not as much.
Perfect. All right, so the myths have been busted.
That's right.
All right, so moving into our next segment, we brought in Jesse Wilkins today, our investment analyst with Falcon Wealth Advisors. So we won't just have you sit there the whole show, Jesse. But we wanted to go into our next segment, which is questions worth asking. And one that's, kind of popped up into my head a little bit is, the market had a horrible fourth quarter. And I wanted to talk about what happened to that client. And we were fortunate that I don't think we had any clients that did this, but what happened to that person that sold out of all of their stocks on Christmas Eve? They were talking to their family, they were scared, maybe they just retired, they didn't want to see their account go down anymore. What happened to that person that did that?
Well, they would have missed out on 14% of upside. And we talked in the last show that I was on about the financial crisis. And if you would have sold out of the stock market when it was at its bottom, you would have missed out on 300%. So we have an investing principles thing that's going to be on the website soon. And one of the most important ones that I have on there is don't sell when you are fearful, and don't buy when you're greedy. I think keeping fear and greed out of the investment market is one of the most important things any investor can do.
Yeah, it's a really good point. So we just saw that. I mean, we had a real world example. Literally the stock market's up around 14% since Christmas Eve. I mean, we're talking a little over a month.
Yeah,
and that's some wicked volatility, and the thing can whipsaw back and forth, and it just shows that you can't put all of your money in or all of your money out and try to time this thing because it's very risky. Did you want to add anything to that question?
As far as that question goes, no, I think the feeling that probably some people had on Christmas Eve, and I know it from talking to other people, was that that's when the fear kind of got real. Things pulled back so much, the market was only open half a day, and that's when people really started to ask the question, well, how bad can this get? Maybe I'm better off just getting out now before I lose anymore. Because I think that's what creeps into people's heads.
Yeah, they think it's going to keep going straight down. As humans, we're linear thinking, at least, and we think in straight lines, and it doesn't work that way.
It's usually not until it reaches a very specific pain point when people start saying, well, oh, this is normal to, oh, shoot, this could be really bad. Maybe I better get out now. But if you're starting to think that way, that's typically going to be the very worst time to sell your stocks,
yeah,
right?
That's always the worst time. When you're really feeling the pain and when you're seeing markets selling off like that, that's when you want to stay in and maybe buy more. I mean,
right. That's a really, really good point.
Close out your browser and go do something else,
Right.
Stop watching CNBC.
Yeah, exactly. All right, what question did you have?
So the question I had is, if I'm getting ready to retire, or I'm retiring and I'm not 65 years old, what am I supposed to do about health insurance?
Yeah, this has been a big one that's been coming up with our clients lately. We've got quite a few clients that are looking to retire in their 50s, and Medicare doesn't kick in until they're 65. Now, their employer will, typically COBRA is an option. It's a little bit more expensive, and what COBRA is basically a bridge.
Right.
From when you leave your company, you can stay on your company insurance for 18 months, pay the premiums 100% out of your pocket, but then after that 18 months, you're kind of on your own. And so what we've been doing is we've been out there vetting some health insurance agents to help our clients guide through this. So one way is they go out into the open market, they look at the Affordable Care Act, and they see what that can provide. A lot of people are also looking at maybe getting other jobs, maybe on a part-time basis, that will offer them some sort of healthcare benefit to help bridge that gap. So it's a very hot topic. If your advisor is not helping connect you with somebody that can help you with that, they should be. Again, we don't do health insurance at Falcon Wealth Advisors, but we do look to connect our clients with other professionals that can help find them answers. And frankly, if the professionals we link them to can't find them the answer, we'll keep looking and we'll keep searching for that because it's important to us. Because you can't get health insurance, even though you can afford to retire at age 55 or whatever that may be, you should still get to retire. We just want to make sure that you can get it, that you're covered, that you and your family are covered. So it's a very hot topic right now, and it's a problem. And I think Washington's probably going to change the rules on it because it is kind of tough out there right now. So that's something that we'll be obviously paying very close attention to for our clients. But just know you can retire before 65, but that's one of the boxes that you definitely want to make sure you have checked off is that you have health insurance taken care of.
Exactly, and I also think it is some of the burden and responsibility falls maybe on your advisor to help you just have an idea of what that cost is going to be. You want to know what that is before you retire.
Right, absolutely. We can work that into the financial plan. Make sure, even if it's $2,000 a month, whatever it is, if you have the money and can afford it, I know nobody likes paying it.
Sure.
But in the end, would you rather go work, 50, 60 hours a week, or would you rather go travel? Certainly in Kansas City, it's cold right now. And if I had the money to retire and I was in my 50s and I could go to Florida, or Mexico or wherever, and I could afford it, it might be worth paying a little bit of extra money for my health insurance.
Yep.
All right, perfect. So questions worth asking. Again, we are always open to our viewers. If you guys do have any questions that you'd like us to address on the show, we're certainly happy to do that. We also brought on Jesse today that we wanted to just to kind of get your take on kind of where we think things are headed and kind of what the heck happened in January. A heck of a month.
Yes, we talked about the market sell-off in late December, which was terrible for the market. I mean, it went down, 15%, almost 20%, which would have been the official bear market. We didn't quite reach that point. We were almost there, but we didn't quite get there. And then we've seen this great rally since then, and the rally's been as dramatic as the sell-off was. So there's been three main things that we've been watching, which is China, the Fed, and earnings, which I know this seems like I'm beating a dead horse, but it's really the most important thing in the market right now. And we're getting closer to a China deal. Trump came out. He was with the vice premier of China on Thursday. and they came out and had a joint statement, and it looked very positive and looked like we're getting closer to a deal, which is very positive for the markets, especially with all these macroeconomic things out there right now. You got Brexit, kind of a global slowdown in growth. So getting that China deal done is going to be one of the most important things for the market, especially early in this year. Then we look at earnings. It's almost a complete reversal of what we saw in the third quarter earnings when they were being reported. People were beating the benchmarks that Wall Street set, and they were getting killed in the after hours. And now we're seeing people miss, and they're lowering their guidance, and now they're going back. They're going up in after hours. So
Why do we have any rationale behind that? Why is that?
I think the sentiment was so bad in that fourth quarter from October to December that we're kind of just repricing everything right now. We're getting back to what regular prices would be. And I think from here, what I'd like to see is just kind of a market consolidation where we're kind of trading sideways and figuring out where we're at in the market. I think as dramatic and great as the rally has been, I don't know if it's sustainable. But a period where we're just kind of trading sideways instead of going up or down at a dramatic rate would be, I think, good for the market right now.
And the Fed. So the Fed came out earlier this week, and they had some comments. They didn't raise interest rates, which was expected. What else did they say, basically?
They're basically saying they're being patient. I think there was a counter on CNBC where how many times Jerome Powell said patient in the press conference. He said it like 5 or 6 times. So they're going to just be watching data, be more data completely changed since October and late in the fourth quarter 2018, which has been good for markets. It's going to be interesting when we get to a point where we wish the Fed were raising rates because the economy was that good. I think there's been obviously a slowdown in economic growth, and it's been projected for 2019 and 2020. So it might get to a point where instead of being happy that they didn't raise rates, we're to a point where we wish the economy was good enough that they could raise rates.
Gotcha, makes good sense. So what I'm hearing is the China deal is getting closer to happening. The Fed is being patient, and earnings, while maybe they haven't been as great, the market's kind of basically being repriced.
Right.
So without getting into specifics with our clients' portfolios, what are we looking to do at Falcon Wealth Advisors to maybe, so we rode the market down a little bit. I know we got more active in the fourth quarter. We did some more trades for our clients to not only help protect them on the downside, but we're also looking to take advantage of a bounce back, so we've gotten a bounce back. So what are you looking at as far as our research for our clients?
So we're looking at stocks that that are below their price targets, and we don't know if they're ever going to hit the prices that we purchased them
Gotcha.
at. So we're looking at stocks that maybe have been weak in the past and have had this dramatic bounce back in the beginning of this year. But maybe we're looking at other places that we think have better investment opportunities.
Gotcha. So we've ridden the bounce up back, but we're still not just sitting on our hands. We're staying active and nimble, and we're going to use this opportunity, this bounce back, to maybe some of those stocks that we were hoping would do better when we initially bought them. They've had a nice little rally, so maybe it's time to get rid of those and go into something that we think can take us up to higher levels.
Right. I think those stocks are going to be ones that will come back a lot faster than the stocks that have done well in the past. So the stocks that got hit the hardest in the sell-off are going to be the one that rallied the most.
Makes sense.
But going forward, I think we want to look at better investment opportunities long term.
Gotcha. So again, we're staying active at Falcon Wealth Advisors. We're not just sitting back. We don't believe in buy and hold. So again, we're being strategic with our changes, but we're still certainly being active in this environment. Okay, good. So now for our fun global topic. I didn't tell you guys what I was going to talk about today on this. I always like to spring it on you. As of the airing of this show, football season will be behind us. And so now my attention is turning to college basketball. So KU, I'm a KU fan. It's right down the street. My wife,
Like everyone.
well,
I'm just kidding.
My wife went to
Only
college.
basketball.
Only basketball. That's right. My wife went to college there, so I do have a reason. And I grew up watching KU basketball. But they lost some games here recently. And Jesse, I know you went to KU. You played basketball in high school, so I haven't been watching that closely. Do you know what's going on there with the team?
This is really bad. This is probably one of the worst KU teams that I've seen in recent years, just because there's no leader in the team. I mean, we have Lajovic, and that's like our only senior, and he's just not a leader. He left for the NBA draft. He was already gone and then came back. So I don't think his heart is in it. I don't know about this team.
So he has one foot out the door. Is it Azuki got injured, right? Azubuike got injured.
He's out for the rest of the season. That was our big guy, 7-footer, who's huge and was a huge part of our team. And I don't know.
So mediocre season. Are they going to win the Big 12? Wasn't it 13 years in a row they won the
Yeah,
Big
13 or 14.
Yeah.
The Big 12's not that strong this year, so that's the other thing. It's like, we're not that great, but the Big 12 isn't that good either. So I think we could still win it. We're still in there. Texas Tech, one of the teams to look out for. Maybe even K-State. You never know.
Didn't KU just lose to Texas?
Yeah.
And they're not even ranked.
No, they're not good.
Wow.
We lost
That's
to West Virginia, too, and they had a losing record. So
Wow.
it's been a bad season. So,
What's KU's record?
16-5.
Are they ranked?
Oh yeah.
Yeah, we're ranked 11th. I mean, like, we were
So
talking about
that's why I was like, I mean, I think it's funny that it's a good thing.
Were they number one though? They were number
Yeah.
one and undefeated a little as maybe 3 weeks ago.
Yeah, I guess I mean
A month ago,
if
maybe.
you're a KU fan and this is what a bad season looks like,
Yeah, for 75% of the
Yeah.
colleges out there,
they
this
would
is
love
like
to
the
have
best season ever.
Exactly.
Yeah, no. What about you? Are you been following the Tigers? I know you're an MU fan.
Not really. I
He laughed at you.
no, I don't. I mean,
Don't they have a really good coach now though?
yeah, a lot of people like him.
Yeah.
I think he's good. I think I actually just got a little educated on this last weekend because I didn't know much about it. But they said that a lot of people really like the coach. They like his ability to recruit, and I think their defense plays really well. But they don't have many people that are very good shooters. I think they've had their issues. As far as I know, there's really not any real expectations.
Do you have another college
for the
team that you root for?
No, not really.
So just MU?
Yeah, I like watching Duke play just because they have that big guy. I don't like
You don't like Duke.
I mean,
You don't-
I don't really like Duke. I just like watching that guy play.
All right, fair
But
enough.
I don't. What's his name? Zion.
Zion Williams.
Yeah, I mean he's a good player, but I would if Duke was playing KU, I would. I don't know who I would cheer for in that. I might have to choose my words wisely. There. But
Fine. A lot of our clients aren't KU fans, and that's fine.
sure, no, I know, and it's. Generally speaking, I like when KU has success because I think it makes everybody around here is KU fans.
Well, not everybody.
Well-
I'd argue a lot of our clients don't like KU.
Yeah, that's true.
So
I guess it seems like so many people I interact with are big KU fans.
maybe
Not all
maybe
of
it's
them.
because it's me. I
Yeah,
don't know.
maybe.
But the reason I bring it up is that we're actually starting a show. It's going to be airing Wednesday nights on ESPN Kansas City, our local AM radio affiliate 810. I think their station's 1540 or is it 1510?
I think it's 1510.
1510 and 94.7.
I believe so.
I think it's 94.7 on FM. We're going to be on Wednesday nights around 5:30, and we're going to be talking about money in sports. So we're going to talk about how the two are intertwined, and I'm really looking forward to it. I think our next show will air probably the first week of February, again on Wednesday nights. So I wanted to give a little plug out there, so certainly our audience can find us out on ESPN Kansas City now as well.
If the first show is money and sports about college basketball, that's going to be a tough one.
Yeah, I don't know. We haven't decided the topic yet. I think
gotcha.
I'm having a meeting
That's gonna be
soon. We're going to talk about. So it should be a fun exercise for us. And then, as always, you certainly can find us on almost all of the social media outlets. So we're on Facebook, Twitter, Instagram, of course, LinkedIn. You can find me on Twitter at Jake Falcon CRPC.
You can find me on Twitter at Corey Bittner KC.
And Jesse, I think you prefer email as your direct contact.
Yes, Jesse at Falcon Wealth Advisors.
Perfect. Thank you all for tuning in, and we hope you have a great week.